Real estate investors constantly seek strategies to maximize returns. One of the most powerful tools at their disposal is the 1031 exchange. This exchange, named after Section 1031 of the Internal Revenue Code, allows investors to defer capital gains taxes. This deferral is achieved by reinvesting profits from the sale of an investment property into a similar property. Understanding the concept of tax deferral is key to unlocking the potential of the 1031 exchange. Imagine selling a property and having a significant tax liability on the profit. This tax burden can significantly impact your ability to reinvest. With a 1031 exchange, instead of paying taxes immediately, you can reinvest those funds into a new property. This reinvestment not only defers the taxes, but also allows your capital to grow tax-free. It's like giving your investment portfolio a significant boost. The beauty of tax deferral is that it's not just a one-time benefit. When you eventually sell the replacement property, you can initiate another 1031 exchange. This cycle of reinvestment and tax deferral can continue indefinitely, allowing your wealth to compound exponentially over time. The power of compounding, coupled with tax deferral, makes the 1031 exchange a compelling strategy for long-term wealth creation. However, it's important to note that the 1031 exchange is not a tax avoidance strategy, but a tax deferral strategy. Eventually, when you sell the property without utilizing another exchange, you will be liable for capital gains taxes. However, the ability to defer taxes for years, if not decades, provides a significant financial advantage. The concept of like-kind exchanges predates modern tax codes, with roots in ancient bartering systems. Farmers would trade livestock or crops of similar value, eliminating the need for currency and recognizing the inherent value in exchanging similar assets. This principle of exchanging like-kind assets laid the foundation for the 1031 exchange as we know it today. The modern iteration of the 1031 exchange emerged in the early 20th century, becoming codified in US tax law in 1921. Initially, the exchange was limited to direct swaps of similar properties, often involving adjacent parcels of land. As real estate markets evolved, so too did the 1031 exchange. The rules were broadened to accommodate more complex transactions and a wider range of properties. The evolution of the 1031 exchange reflects the government's recognition of its economic benefits. By incentivizing reinvestment, the 1031 exchange fosters economic activity and promotes growth in the real estate sector. It provides investors with the flexibility to adapt their portfolios to changing market conditions without facing immediate tax consequences. This flexibility encourages investment and contributes to the overall health of the real estate market. Over the decades, the 1031 exchange has weathered various legislative changes, withstanding attempts to repeal or limit its scope. This resilience is a testament to its enduring value for both investors and the economy as a whole. As we delve deeper into the intricacies of the 1031 exchange, we'll see how this historical context has shaped its current form and continues to influence its application in modern real estate investing. Real estate has long been a cornerstone of wealth building, offering the potential for appreciation, cash flow, and tax benefits. The 1031 exchange amplifies these advantages, providing investors with a powerful tool to optimize their real estate portfolios. By understanding how the 1031 exchange aligns with broader real estate investment strategies, investors can unlock its full potential. One of the primary benefits of the 1031 exchange is its ability to unlock equity trapped in appreciated assets. As a property appreciates, so too does the potential capital gains tax liability. This liability can make it challenging to sell an appreciated property and reinvest the proceeds. The 1031 exchange removes this barrier, allowing investors to access and reinvest equity without triggering a taxable event. Moreover, the 1031 exchange provides unparalleled flexibility in portfolio management. Investors can use it to diversify their holdings by exchanging out of one property type into another, or by geographically diversifying their investments. They can also leverage the exchange to transition from actively managed properties to more passive investments, such as Delaware Statutory Trusts, DSTs, which offer fractional ownership in larger, professionally managed properties. The 1031 exchange is not just for seasoned investors with large portfolios, it can be equally beneficial for investors starting their real estate journey. By understanding the rules and strategies involved, new investors can leverage the 1031 exchange to accelerate their path to wealth creation. Whether you're a seasoned investor or just starting out, the 1031 exchange offers a unique opportunity to optimize your real estate investments and achieve your financial goals. However, navigating the complexities of the 1031 exchange requires careful planning and adherence to strict regulations. In the following sections, we will delve into the intricacies of the 1031 exchange, providing a comprehensive guide to help you understand its requirements, benefits, and potential pitfalls. Armed with this knowledge, you can confidently incorporate this powerful tool into your real estate investment strategy. The 1031 exchange hinges on the concept of like-kind property. While this might seem straightforward at first glance, the IRS definition of like-kind property is broader than you might expect. It doesn't necessarily mean swapping one apartment building for another identical one. Instead, it refers to properties held for investment or business purposes within the realm of real estate. For example, you could exchange a rental property for a vacant lot, a shopping centre for a piece of farmland, or even an interest in a real estate partnership for a commercial building. The key is that both the relinquished property, the one you sell, and the replacement property, the one you buy, are held for productive use in a trade or business or for investment purposes. However, there are some exceptions to the like-kind rule. For instance, you cannot exchange real property held primarily for sale, such as inventory in a real estate development business. Similarly, properties held for personal use, like a primary residence, are not eligible for a 1031 exchange. Understanding these nuances is crucial for determining whether a 1031 exchange is a viable option for your specific situation. While the broad definition of like-kind property offers flexibility, it's important to note that the IRS scrutinizes 1031 exchanges closely. The properties involved must genuinely be held for investment or business purposes, and the exchange must adhere to strict timelines and procedures. Consulting with a qualified tax advisor or real estate attorney experienced in 1031 exchanges is highly recommended to ensure you meet all the requirements. Navigating the intricacies of like-kind property can be complex, but understanding the basic principles is essential for unlocking the potential of the 1031 exchange. By carefully assessing your investment goals and seeking expert guidance, you can leverage this powerful tool to optimize your real estate portfolio and achieve significant tax advantages. Section 2, the clock is ticking. Understanding 1031 timelines. Time is of the essence in a 1031 exchange. Strict deadlines govern both the identification and acquisition phases of the process. Failing to meet these deadlines can disqualify the exchange, resulting in immediate tax liability on the capital gains. Understanding these timelines is paramount for a successful 1031 exchange. The first critical timeline begins the moment you sell your relinquished property. You have a 45-day window to identify potential replacement properties. This identification must be in writing and clearly specify the properties you're considering. You can identify up to 3 properties, or a larger number, under certain rules, providing some flexibility in your search. Once you've identified potential replacement properties, the second crucial deadline kicks in. You have 180 days from the sale of the relinquished property or the due date of your tax return for the year of the sale, whichever comes first, to acquire the replacement property. This 180-day period includes the 45-day identification window, leaving you with 135 days after identification to close the deal on your chosen property. These tight timelines necessitate careful planning and efficient execution. it's essential to start searching for potential replacement properties well before selling your relinquished property. Engaging a qualified intermediary who will hold the proceeds from the sale and facilitate the exchange process is crucial for managing these deadlines and ensuring a smooth transaction. While the 45-day and 180-day deadlines are the most critical, other time-sensitive aspects of the 1031 exchange require attention. For instance, specific rules govern the timing of notices to the IRS and other parties involved in the exchange. Failure to adhere to any of these timelines can jeopardize the entire exchange, highlighting the importance of meticulous planning and expert guidance throughout the process. Section 3. The Qualified Intermediary, your 1031 guide. The role of a qualified intermediary, or QI, is paramount in a 1031 exchange. This independent third party acts as a facilitator, ensuring the exchange complies with all IRS regulations and managing the intricate details of the transaction. Choosing the right QI is crucial, as their expertise and experience can make or break a successful exchange. The QI's primary responsibility is to hold the proceeds from the sale of your relinquished property. This is not a simple escrow arrangement. The QI must hold the funds in a way that satisfies specific IRS requirements to maintain the tax-deferred status of the exchange. They then use these funds to acquire the replacement property on your behalf, completing the exchange process. Beyond handling the funds, the QI plays a vital role in ensuring all documentation is accurate, complete, and submitted on time. They prepare the exchange agreements, coordinate with the closing agents for both the relinquished and replacement properties, and manage all communication with the parties involved. This meticulous attention to detail is essential for a successful and compliant 1031 exchange. Choosing a reputable and experienced QI is paramount. Look for a QI with a proven track record, strong financial standing, and a deep understanding of 1031 exchange regulations. Interview multiple QIs, ask for references, and carefully review their fees and services before making a decision. Remember, the QI plays a critical role in safeguarding your financial interests and ensuring the tax-deferred benefits of your 1031 exchange. While the QI handles the technical aspects of the exchange, it's essential to remember that you, the investor, are ultimately responsible for making the investment decisions. The QI cannot provide investment advice or influence your choice of replacement property. Therefore, it's crucial to conduct thorough due diligence on potential replacement properties and seek independent financial and legal advice to make informed investment decisions. Section 1. Unlocking tax deferral, the cornerstone of 1031. The 1031 exchange's most compelling advantage is its ability to unlock the power of tax deferral. Imagine selling a property that has significantly appreciated in value. Without a 1031 exchange, you'd face a hefty capital gains tax bill, potentially diminishing a significant portion of your profits. The 1031 exchange allows you to defer those taxes, reinvesting the full amount and harnessing the power of compounding growth. This deferral is not merely a temporary reprieve, it's a strategic advantage that can significantly impact your long-term wealth building. By reinvesting the full sale proceeds, you're essentially giving your money a head start, allowing it to grow tax-free for years, if not decades. Over time, this tax-deferred growth can snowball, resulting in a substantially larger investment portfolio compared to paying taxes up front. Think of it as a continuous cycle of reinvestment and growth. Each time you utilize a 1031 exchange, you defer taxes, preserving capital and maximizing your reinvestment potential. This compounding effect, combined with the potential appreciation of real estate assets, can create a powerful engine for wealth generation. It's important to remember that tax deferral is not tax avoidance. Eventually, when you sell a property without utilizing another 1031 exchange, you will be liable for capital gains taxes on the accumulated profits. However, the ability to defer those taxes for an extended period allows you to harness the time value of money, putting your capital to work and reaping the rewards of tax-deferred compounding. This makes the 1031 exchange a particularly attractive strategy for long-term investors seeking to maximize their returns. Unlocking tax deferral through the 1031 exchange is more than just a tax strategy. It's a mindset shift. It's about adopting a long-term perspective on wealth creation, leveraging the power of compounding growth, and strategically managing your tax liability to optimize your investment outcomes. By understanding and harnessing the power of tax deferral, you can unlock a world of possibilities for growing your real estate portfolio. Section 2. Amplified purchasing power. Stretching your investment dollars. Beyond tax deferral, the 1031 exchange offers another significant advantage: amplified purchasing power. When you sell an investment property, a portion of the proceeds typically goes towards capital gains taxes. This reduces the amount of capital you have available to reinvest in a new property. However, with a 1031 exchange, you can reinvest the entire sale proceeds, effectively stretching your investment dollars further. This increased purchasing power opens up a world of possibilities. You can use it to acquire a more substantial property, potentially generating higher cash flow or appreciating at a faster rate. You can diversify your portfolio by acquiring multiple properties or venturing into new markets. This flexibility allows you to adapt your investment strategy to changing market conditions and capitalize on emerging opportunities. Imagine selling a small apartment building and using the proceeds to acquire a larger complex with more units. The increased rental income can significantly boost your cash flow and overall return on investment. Or consider using the proceeds from selling a property in a saturated market to invest in an emerging market with higher growth potential. The 1031 exchange empowers you to make strategic investment decisions that align with your long-term goals. This amplified purchasing power is particularly valuable in competitive real estate markets. Having access to the full amount of your sale proceeds gives you a competitive edge when making offers, potentially allowing you to secure desirable properties that might otherwise be out of reach. It also provides a buffer against potential market fluctuations, as you'll have more equity in your new investment, mitigating risk and enhancing your overall financial stability. By maximizing your reinvestment potential, the 1031 exchange empowers you to think bigger and bolder with your real estate investments. It allows you to scale your portfolio more rapidly, access a wider range of investment opportunities, and ultimately accelerate your path to financial freedom. Section 3. Diversification and growth. Building a resilient portfolio. Diversification is a fundamental principle of sound investing, and the 1031 exchange provides a powerful tool for diversifying your real estate holdings. By exchanging one property for another, you can diversify across property types, geographical locations, and even investment strategies. This diversification can mitigate risk, enhance returns, and create a more resilient portfolio capable of weathering market fluctuations. Consider an investor who owns several rental properties in a single city. While this concentration may provide steady cash flow, it exposes the investor to risks specific to that market, such as economic downturns or changes in local regulations. Utilizing a 1031 exchange, the investor could diversify geographically, acquiring properties in different cities or states, spreading risk and potentially tapping into new markets with stronger growth potential. Beyond geographical diversification, the 1031 exchange allows for diversification across property types. An investor holding primarily residential properties could exchange into commercial real estate such as office buildings, retail centers, or industrial properties. This diversification can provide exposure to different rental cycles, tenant profiles, and appreciation patterns, reducing overall portfolio volatility. Furthermore, the 1031 exchange can facilitate a shift in investment strategies. An investor looking to transition from actively managing properties to a more passive approach could exchange into a Delaware Statutory Trust, DST. DSTs offer fractional ownership in larger, professionally managed properties, providing passive income and diversification without the day-to-day responsibilities of property management. By embracing the diversification opportunities offered by the 1031 exchange, you can build a more resilient real estate portfolio. This resilience stems from spreading risk, capturing growth across different market segments, and aligning your investments with your evolving financial goals. Whether you're seeking geographical diversification, exposure to new property types, or a transition to a more passive investment approach, the 1031 exchange provides the flexibility to shape your portfolio strategically. Section 1. Initiating the exchange from relinquished to replacement. Executing a successful 1031 exchange involves a series of carefully orchestrated steps, each governed by specific rules and timelines. Understanding this process is crucial for avoiding potential pitfalls and ensuring a smooth and compliant exchange. This section outlines the key stages involved, from the initial sale of the relinquished property to the final acquisition of the replacement property. The journey begins with identifying a relinquished property, the asset you wish to sell and exchange. This property must meet the like-kind criteria and be held for investment or business purposes. Once you've identified a buyer and negotiated the terms, it's time to engage a qualified intermediary, QI. The QI will prepare the necessary exchange documents and hold the proceeds from the sale in a qualified escrow account. With the QI in place, the sale of the relinquished property proceeds as a typical real estate transaction. However, instead of receiving the proceeds directly, they are transferred to the QI's escrow account. This transfer is crucial for maintaining the tax-deferred status of the exchange. Remember, the investor cannot receive the funds directly at any point during the exchange process. Once the sale of the relinquished property closes, the 45-day identification period begins. Within this time frame, you must identify potential replacement properties in writing and provide the details to the QI. After identifying the replacement property, you have 180 days from the sale of the relinquished property to acquire it. The QI will use the funds held in escrow to facilitate the purchase, completing the exchange. Throughout this process, adhering to the strict timelines and documentation requirements is paramount. The QI plays a crucial role in managing these aspects, ensuring the exchange complies with all IRS regulations. However, it's ultimately the investor's responsibility to make informed investment decisions and select suitable replacement properties. Section 2. Navigating potential pitfalls, avoiding common 1031 mistakes. While the 1031 exchange offers significant advantages, it's not without potential pitfalls. Understanding these common mistakes and how to avoid them is crucial for ensuring a successful and compliant exchange. This section highlights some of the most frequent errors investors make and provides guidance on how to navigate these challenges. One common mistake is failing to meet the strict 45-day and 180-day deadlines. These timelines are unforgiving, and missing them can disqualify the entire exchange, resulting in immediate tax liability. Careful planning, early engagement of a QI, and diligent execution are essential for meeting these critical deadlines. Another pitfall is failing to properly identify replacement properties. The identification must be in writing, clearly specify the chosen properties, and meet specific IRS requirements. Vague or incomplete identifications can jeopardize the exchange. Working closely with the QI and potentially consulting a real estate attorney can help ensure proper identification. Investors sometimes make the mistake of receiving funds directly from the sale of the relinquished property, even if unintentional. This commingling of funds can disqualify the exchange. It's crucial to establish a clear understanding with the QI and all parties involved that the funds must flow directly through the qualified escrow account. Another potential issue arises when investors try to use the 1031 exchange for personal use properties. The exchange is strictly for investment or business properties. Attempting to circumvent this rule, such as by temporarily renting out a primary residence, can raise red flags with the IRS and lead to audits and penalties. Navigating these potential pitfalls requires vigilance, attention to detail, and a thorough understanding of the 1031 exchange rules. Engaging experienced professionals such as a qualified intermediary, real estate attorney, and tax advisor can provide invaluable guidance and help mitigate the risk of costly mistakes. Section 3. Expert Guidance, Assembling Your 1031 Team. Given the complexities and intricacies of the 1031 exchange, assembling a team of experienced professionals is crucial for a smooth and successful transaction. This team, working in concert with the investor, can provide expert guidance, ensure compliance with all regulations, and help navigate the potential pitfalls along the way. The Qualified Intermediary, or QI, serves as the cornerstone of your 1031 team. As the facilitator of the exchange, the QI holds the proceeds from the sale, manages the timelines, prepares the necessary documentation, and ensures compliance with IRS regulations. Choosing a reputable and experienced QI is paramount. A knowledgeable real estate attorney specializing in 1031 exchanges is another invaluable asset. They can provide legal advice on structuring the exchange, review contracts and agreements, address any title or legal issues with the properties involved, and ensure all documentation meets legal requirements. A tax advisor with expertise in real estate taxation is essential for understanding the tax implications of the exchange. They can help you analyze the potential tax consequences, optimize your tax position, and ensure you comply with all reporting requirements. Beyond these core team members, you might also consider engaging other professionals, such as a real estate broker specializing in 1031 exchanges to assist with finding suitable replacement properties, a financial advisor to provide investment guidance, and an insurance broker to ensure adequate coverage for all properties involved. Assembling a team of experienced professionals is not just about delegating tasks, it's about leveraging their expertise to your advantage. Each team member brings a unique perspective and specialized knowledge, working together to guide you through the complexities of the 1031 exchange process. This collaborative approach helps mitigate risk, optimize outcomes, and enhance the likelihood of a successful and beneficial exchange. The 1031 exchange has stood the test of time, weathering economic cycles and legislative changes to remain a cornerstone of real estate investing. Its enduring power stems from its ability to align with fundamental investment principles, providing a strategic advantage in an ever-evolving market. As we've explored throughout this guide, the 1031 exchange is not merely a tax deferral strategy. It's a powerful tool for wealth creation, portfolio optimization, and long-term financial growth. The ability to defer capital gains taxes is a significant driver of the 1031 exchange's enduring appeal. This deferral allows investors to reinvest the full proceeds from the sale of an investment property, maximizing their reinvestment potential and harnessing the power of compounding growth. Over time, this tax-deferred compounding can significantly amplify returns, outpacing traditional investment strategies burdened by immediate tax liabilities. Moreover, the 1031 exchange's flexibility makes it an adaptable tool for navigating the dynamic world of real estate. Investors can leverage the exchange to diversify their holdings across property types, geographical locations, and investment strategies, mitigating risk and enhancing portfolio resilience. This flexibility allows investors to adapt to changing market conditions, capitalize on emerging opportunities, and align their real estate holdings with their evolving financial goals. The 1031 exchange's enduring power also lies in its ability to facilitate the growth and revitalization of communities. By incentivizing reinvestment, the exchange promotes economic activity, creates jobs, and contributes to the development of new and improved properties. This ripple effect extends beyond individual investors, benefiting communities and the broader economy. The 1031 exchange is more than just a transaction. It's a strategic tool for wealth creation, empowering investors to build and preserve their assets over time. By understanding the nuances of the exchange, investors can leverage its benefits to achieve their long-term financial goals, whether it's securing financial independence, building a legacy for future generations, or simply maximizing their return on investment. One of the key ways the 1031 exchange facilitates wealth creation is by unlocking equity trapped in appreciated assets. As properties appreciate in value, so too does the potential capital gains tax liability. This liability can make it challenging to sell an appreciated property and reinvest the proceeds without incurring a significant tax burden. The 1031 exchange removes this barrier, allowing investors to access and reinvest their equity without triggering a taxable event, effectively preserving capital and fueling further growth. Moreover, the 1031 exchange's ability to amplify purchasing power enables investors to acquire larger, more profitable assets over time. By reinvesting the full sale proceeds, investors can gradually scale their portfolios, increase their cash flow, and benefit from the potential appreciation of more substantial properties. This upward trajectory, fueled by tax-deferred compounding and strategic reinvestment, can significantly accelerate wealth accumulation. Beyond its financial benefits, the 1031 exchange offers investors peace of mind, knowing they have a strategic tool to navigate market fluctuations and life's uncertainties. Whether it's adapting to changes in investment goals, diversifying to mitigate risk, or managing an unexpected life event, the 1031 exchange provides flexibility and control, empowering investors to make informed decisions that align with their evolving needs. Successfully utilizing the 1031 exchange requires more than just understanding its mechanics. It demands a shift in mindset, embracing a long-term perspective on wealth creation. This mindset recognizes that building wealth through real estate is a journey, not a sprint, and that strategic decisions made today can have a profound impact on your financial future. The 1031 mindset is characterized by patience, discipline, and a willingness to play the long game. It recognizes that tax deferral is not a get-rich-quick scheme, but a powerful tool for compounding growth over time. It involves resisting the temptation to cash out prematurely and instead focusing on reinvesting profits, leveraging the power of compounding to build a more substantial financial foundation. This mindset also emphasizes the importance of continuous learning and adaptation. Real estate markets are constantly evolving, and staying ahead of the curve requires staying informed about market trends, regulatory changes, and emerging investment strategies. By embracing a mindset of continuous improvement, investors can refine their approach to the 1031 exchange, ensuring it remains a relevant and effective tool for achieving their financial goals. The 1031 mindset also recognizes the value of seeking expert guidance. Navigating the complexities of the 1031 exchange requires a team of experienced professionals, including qualified intermediaries, real estate attorneys, tax advisors, and other specialists. By surrounding yourself with a knowledgeable team, you can mitigate risk, optimize outcomes, and focus on making informed investment decisions. As you embark on or continue your real estate investment journey, remember that the 1031 exchange is a powerful tool at your disposal. Whether you're a seasoned investor seeking to optimize your portfolio or a newcomer exploring the potential of real estate, understanding the intricacies of the 1031 exchange can significantly enhance your investment outcomes. As we've explored throughout this guide, the 1031 exchange offers numerous advantages, from tax deferral and amplified purchasing power to portfolio diversification and enhanced wealth creation potential. However, it's essential to approach this strategy with careful planning, diligent execution, and a commitment to compliance with all applicable regulations. Remember, the The 1031 exchange is not a one-size-fits-all solution, and its suitability depends on your individual circumstances, investment goals, and risk tolerance. Consulting with experienced professionals such as qualified intermediaries, real estate attorneys, and tax advisors is crucial for determining whether the 1031 exchange aligns with your specific needs and for navigating its complexities effectively. Embrace the power of the 1031 exchange, but do so with a clear understanding of its requirements, benefits, and potential pitfalls. By approaching this strategy with a long-term perspective, a commitment to continuous learning, and a team of trusted advisors by your side, you can unlock its full potential and navigate your real estate journey towards a more secure and prosperous financial future.